The purpose of today's presentation, as Dan mentioned, is really to provide information around the world of bonds. So what we want to do is address those questions, provide some facts for everybody here, and hopefully everybody can leave with a better sense of maybe a different way to look at bonds. The whole thing about Lord Abbett is I've only been with the firm for 5 years, but the firm has been around for a lot longer. We were founded in 1929. 83 years now we've been managing money, and how we've been managing that money is through a private partnership. But this is going to be some of what we're going to talk about. Number one is what we all know, which is the saver's dilemma. As Dan mentioned, we've got CD rates that are incredibly low. Money market rates are at all-time lows. We've got to figure out a way to save money more effectively. Second, we'll look at a historical perspective on interest rates. Take a look at what it means when we say two bond markets. And then, of course, we want to talk maybe about some strategies for today and how we can apply those strategies. But what we're looking at here is a yield on a 20-year government bond index. And for those of you that were around, I know we have some baby boomers in the room. It was not too long ago, 30 years ago, when we saw 13, 14% interest rates. We don't believe what caused really from 1974 to 1981 those dramatic increases in interest rates. We don't believe that that is likely to be repeated anytime, at least in my lifetime. And I might be the youngest guy in this room. Here's why. There are 4 factors you'll see up here: demographics, income, housing, and leverage. Demographics is very important, and it talks about household formation spender-savers ratio. There's something that we look at called this ratio, which basically takes the amount of savers and divides, or excuse me, amount of spenders and divides it over the amount of savers. The second thing here you'll see here is the income, right? We had a wealth effect that was growing. People were making more money. As a society, that large generation was earning more income. They were spending more income. And last but not least is leverage. Again, taking out credit, spending beyond our means, and we know where that has led us. Baby boomers are getting older. Are they more savers or are they more spenders now? We're savers, which is why we're in this conversation and why I'm here to talk about bonds. For the next 50 years, it is estimated that the saver-spenders ratio will be 1.09 to 1.06. What are some other factors that are going to keep rates low? Okay, well, we know we're in a slow economic growth environment, and with that, you couple with global shortage of yield. Everybody in this room is looking for more income. As a result, that increased demand for income pushes prices up on bonds and it pushes the yields down. In addition, debt overhang, deleveraging. We talked about clients, consumers, you guys, businesses hoarding more cash as opposed to saving. That's what we're referring to here. And then short-term rates. We may never see rates back up to 1%, 2%, 3%. We have to look for alternatives. We've got to do it now. We've got to understand the environment that we're in and maybe seek out some better solutions. Should I own bonds or should I not? We don't believe it's a question of should I own bonds or should I not. We believe which bond should I own. Okay, what we're trying to show here is that the bond market could be dissected into 2 different areas. One considered interest rate sensitive fixed income, the other considered credit sensitive fixed income. This is important because these 2 areas of fixed income act differently in different environments. Who here knows what the size of the US stock market is? It's about $17 trillion. So use that as a benchmark. What do you think the size of the US bond market is? Just taxable fixed income.
30.
You're smart. I like you. There's something here that we consider the aggregate bond, right? Which is really the Barclays Agg. It's a benchmark for bonds. This aggregates all these areas of fixed income for the most part. But the bond market acts differently in different environments. When the market's going down or we fear inflation, this side of the aisle does incredibly well, as you can see here. This side of the aisle does not. So you had a 30-year treasury with a 40% return. You had high-yield bonds down 26 and bank loans actually down 28. That is a spread or a difference of 70%. Flash forward to 2009. We see a flip-flop. The market starts to improve. Stock market returned a lot from March of 2009 through the end of the year, and because of that, corporations seem to be more attractive. People trust corporations. The demand for the corporate bonds goes up, and as a result, the 30-year treasury sells off, the 10-year treasury sells off, and these areas of fixed income do better. So if we think that there is an appropriate place to buy fixed income in this environment, hence maybe that's credit-sensitive fixed income, corporate bonds, high-yield bonds, that might be appropriate now while we sit here and wait for the Fed to move. But what happens when the Fed funds rate does go up? So to address this, we want to present 2 different case studies. The Fed really has 2 decisions when it comes to raising that Fed funds rate. Here's the 2 case studies, 1994 and 2004. Here's what happened. We had rapid inflation. There was a fear of hyperinflation. You had a Fed that was very, very vague and exactly what they were going to do. Nobody really knew what was going to happen when the Fed had a meeting. Was the rate going to go up? If so, by how much? It was very uncoordinated, very unorchestrated, and the result was over the course of one solid year, you saw a 3% increase in the Fed funds rate. And all I want you to focus on here is 3%. That's a pretty large number over 1 year, but it was also, nobody knew what was going on. One was 25 basis points, the next one was 50 basis points, the next one was 75 basis points. In that environment, bonds have a tough time knowing what's going on because the interest rate that you have, who knows if that's going to be valuable down the road because you don't know what the Fed is doing with the benchmark interest rate, which is going to dictate whether or not my bond that I own is going to be valuable with the current rate that I have. So you can see across the board it looks nasty. You have 30-year treasuries down, 10-year treasuries down. The only market that did very well was a 3-month T-bill because it's very, very short, and a bank loan. And the only reason why this does well is because this is tied to LIBOR. So as the Fed funds rate goes up, LIBOR went up, and as a result, your yield in this portfolio went up as well. So these did well. What's the second scenario? The second scenario is what we saw from 04 to 06. Wouldn't it be nice to go back to the markets from 04 to 06? Much better time then. We knew what was going on. We can say that. The difference with this versus 1994 is this one was very articulate. We knew what was going to happen. We actually heard that the Fed was going to meet, and every time they met, they would raise the Fed funds rate by 25 basis points until they deemed unnecessary. So they met 17 consecutive times, and 17 consecutive times they rose exactly what they said they were going to raise. When the bond market, bond managers, bond analysts like Lord Abbott understand what the Fed funds rate is likely to do, fixed income does a lot better. So we hear this term, I fear being in fixed income in a rising interest rate environment, but in all reality, you did okay. Even this side of the aisle did pretty good. This side is better, and we still like this over that. But we are in an environment now that is more like 2004 to 2006. I wanted to present this basically to prove that given an active manager, we can actually do very well in a rising interest rate environment. The good news is now, this area of fixed income, does it yield more or less than this area of fixed income?
Looks like more.
So these are returns, right? So that's kind of I'm not showing you information that would help you with the answer, but these are actually yielding more. Our treasury bond, our 10-year treasury right now, does anybody know what the yield is on the 10-year treasury? And that's not it, that's a return, but it's right around 1.73. That's low, very low. It shouldn't be that low. But your 10-year corporate bond, if it's an investment grade corporate bond or a high yield bond, can yield you 3, 4, 5, 6, 7, 8%. So you can get a much better yield right now while you wait, and as fixed income, Fed funds rate maybe goes up, you're going to be positioned in a better way to preserve your principal and maybe capture more income. The Fed is on hold for the foreseeable future. The Fed last week on Thursday made a huge leap. If anybody heard it, this will sound familiar for those that didn't. Basically, he said, we're going to provide quantitative easing 3. And we've seen in the past he's done 1, 2, something called Operation Twist, and now quantitative easing. Quantitative easing is just a means of providing more capital to the markets to try to stimulate more lending. But the QE3 became QE3, 4, 5, and 6. It was much more than the markets anticipated. And we got a lot of language from him that, number one, it's good to have a Fed, to the most part, that is behind the markets. He's trying to do everything he can to make us not go back into a recession. We can argue all day on whether or not we agree with him, but that is a fact. And we might have to deal with inflation down the road. We probably will. But for right now, we know that they're on hold for the foreseeable future in terms of rising rates. Operation Twist is going to continue indefinitely, but we've got economic growth that's positive. They just want to see it improve. If the recovery is real, and this goes back to what we were saying, we do believe that it is. We don't believe we're going back into a recession. Credit products should continue to outperform. Last but not least, rising rate are not an immediate threat, but something to keep an eye on. So this is when it becomes fun, right? So here we are. This is all great dictation, but what does it mean to my portfolio? First bullet point here where it says a small step in risk could mean a gigantic pickup in yield. There's a solution, and this is where I'll pause for a second because this is where Dan is familiar with Lord Abbott, and we don't want to talk too much about product, but it's nice to know the options that are out there available to y'all so you kind of know the information, know the facts, and then can make an educated decision. At Lord Abbott, we manage a fund called the Short Duration Income Fund. It's a fund that's very short in duration, as the name suggests, very conservative in the fixed income investments that it's in, but it generates a better income stream. Right now, we're competing with CDs that are basically, on average, it's around 30 basis points as the national average for a one-year CD. Should be a little bit lower than that, but with some credit unions that can offer a little bit more yield, it is around 30 basis points. Our portfolio yields 4%, which is great, but the difference between a CD, let's remember, CDs are FDIC insured, right, up to $250,000. Ours is not. We don't have a guarantee on the principal. So there's risk associated with our investments. In 2008, however, when the market fell off and the stock market was down 37%, our high yield bonds were down 58%, our portfolio was down 1.09%. The reason is because we were very quick to manage certain areas of fixed income. So you saw back before on that slide that showed treasuries that did very well. We couldn't buy the 30-year treasury that was up 40% because we're a shorter portfolio, but we could definitely buy a higher credit quality type fixed income, and that did very well for us. So it mitigated the downside.